Welcome back. If you're looking at the headlines today, everything feels uncertain, doesn't it? We're seeing expensive markets, geopolitical tension, and shifting policies. It's messy. But here is the core message from Goldman Sachs for 2026: do not fear the complexity. Instead, we need to seek the catalysts hidden within it. Today, I'm going to walk you through the investment outlook for 2026. We'll look at why the old rules of investing are breaking down, and exactly where we see the growth engines, from AI to the new trade order, that will drive returns in the years ahead. Let's dive in. First, let's look at the playing field. We are entering a new world order defined by one word: divergence. Look at this. In 2025, almost every major economy was cutting rates. But heading into 2026, the paths are splitting. The Fed is easing, but Japan is hiking, and Europe is pausing. The era of synchronized global growth is over. And it's not just rates. Look at trade. The effective U.S. tariff rate is hitting 18%, levels we haven't seen since the 1930s. Add in a $100 trillion global debt pile, and you have a recipe for serious volatility. So, here's the question for your portfolio: if the world's central banks aren't moving in lockstep anymore, can your passive strategy really keep up? Now, let's talk about the risk sitting in almost everyone's portfolio right now: concentration. This data is staggering. The top 10 U.S. companies are now worth nearly $25 trillion. To put that in perspective, look at the chart. The top 5 U.S. tech firms alone are worth more than the combined GDPs of Japan, India, the UK, France, and Italy. While these are incredible companies with strong fundamentals, this level of concentration creates a hidden risk. If you are just buying the index, you aren't diversified. You are making a massive bet on just a few names. If leadership falters, the pain will be widespread. So, where is the growth? That brings us to our first catalyst, the AI supercycle. There's a lot of debate about whether we are in a bubble. But look at the data. For the past 2 years, analysts have consistently underestimated the amount of money hyperscalers, like Amazon, Google, and Microsoft, are pouring into AI. See that gray bar jumping to 64%? That's the reality beating the estimates. These 5 companies alone account for 27% of all S&P 500 capex. But for 2026, the story is shifting. It's not just about the builders anymore. The opportunity is broadening to the picks and shovels, the companies providing the power, the cooling, and the software to make AI work. We are still in the early innings. While everyone is watching US tech, some of the best value stories are actually being written overseas. We call this the global catch-up trade. Look at Europe. It's not just a stagnant economy. There is a massive capex revival happening. Spending relative to sales is at a 10-year high, driven by defense and energy transition. Then look at Japan, where corporate reform is finally unlocking shareholder value. And emerging markets? They are trading at a 40% discount to the US. The point is, don't let home bias blind you. The catalysts in Frankfurt, Tokyo, and Mumbai are real, and they are priced much more attractively than the S&P 500. Our second major catalyst is what we call the age of economic security. Efficiency is out, resilience is in. 3 things are driving this multi-trillion-dollar wave. 1. Defense. NATO members are ramping up spending to 5% of GDP. 2. Reshoring. We've seen $1.7 trillion in megaprojects announced in North America to bring manufacturing home. And 3. Power. AI data centers are forecasted to drive power demand up 175% by 2030. This isn't just a political narrative, it is an investment reality. Companies that help nations rearm, reshore, and repower are going to be the structural winners of the next decade. Now, let's look at private markets. For a while, there was a fear that private equity valuations were totally detached from reality. But look at this chart. That gap between what companies are held at, the dark blue, and what they are sold for, the light blue, is closing. The valuations are elevated, yes, but they aren't broken. However, the game has changed. You can't just rely on financial engineering anymore. To get returns in 2026, you need real growth. We estimate companies need 10 to 15% EBITDA growth to hit targets. It's a stock picker's market, even in private equity. What about private credit? Everyone loves the yields, but we need to look under the hood. Most of the market is healthy. But look at this slice here, about 15% of borrowers can't cover their interest payments with their current operating profits. This is the danger zone. As we move into 2026, manager selection is going to be paramount. You want to be with lenders who have rigorous underwriting and strong covenants, not just the ones chasing the highest headline yield. There is income to be made here, but you have to be selective. So, how do we put this all together? The old playbook, the passive 60-40 split, is outdated. In a world of high concentration and diverging rates, it's just too risky. For 2026, we need to recalibrate. We are moving toward a more dynamic framework. It keeps a core of fixed income, yes. But it surrounds it with active global equities to capture that international value. It adds thematics like AI and security. And crucially, it includes private equity and credit for diversification. You need to move from rigid silos to flexible solutions. Now, you might be thinking, how do I actually execute this actively? Here is one of the fastest growing tools in our arsenal, active ETFs. Look at this growth curve. Assets have grown 46% annually since 2020. Why? Because investors want the best of both worlds. They want the alpha potential of active management, someone picking the winners in AI or managing duration in bonds, but they want the liquidity, transparency, and tax efficiency of an ETF. This is how you deploy capital with speed and precision in 2026. To wrap up, the world in 2026 is going to be complex. But as we've seen, complexity creates opportunity. From the broadening AI trade to the reindustrialization of the West, and the opportunities in private markets, the catalysts are there. We just have to be active enough to capture them. At Goldman Sachs, our focus is on partnering with you to build that resilient portfolio. Let's turn these challenges into your next growth engine. Thanks for watching. If you found this helpful, please like and subscribe for more insights from our team.